Investors were anxious before today's news and headed for the hills when it hit.
It was a shocker for CSL.
Investors weren't convinced, with the share price plunging.
Some of Australia's biggest companies punished by investors for underwhelming profits.
I don't worry too much about the near-term movements in the share price.
The performance was well below our expectations.
It's been one of the most volatile reporting seasons I certainly can remember.
It was unusual because of the sheer number of corporate giants which saw their share price either plummet or skyrocket after announcing their results. Analysis from JP Morgan shows almost a quarter of companies reported worse than expected earnings.
There seems to be a bit of a disconnect between the valuations of companies and what's happening in the underlying economy. The market's driven a lot through sentiment, and at some point you want to see earnings catch up, or you'll see probably valuations coming back down to earth.
That's what happened to Commonwealth Bank, CSL and Woolworths. All suffered massive share price falls after their profits were lower than what the market was hoping for.
Commonwealth Bank is probably still the most expensive bank in the developed world, so we did see investors pulling some money out of Commonwealth Bank and instead rotating it into some other areas.
CSL stock tumbled almost 17%, its worst single-day sell-off this century. News of 3,000 job cuts and a demerger of its vaccine business didn't go down so well.
CSL was a very disappointing one, which impacted not only on the healthcare space, but as a top 3 company on the Australian market, really impacted on market performance.
And shares of companies which do business in Donald Trump's America, like James Hardie, Reece and Amcor, were hit especially hard after warning they'd be earning less in the year ahead due to tariffs and a US property slowdown. Elfreda Jonker from Alphinity says in this earnings season, about twice as many companies as usual saw their share price surge or plunge by more than 5% on the day of their results.
We have seen 3 years of negative earnings growth, and following the recent downgrades over the last month, 2025 is set to be another negative earnings growth year.
Just 20% of companies beat earnings expectations, while 55% were in line with market forecasts. But one of the bright spots was the gold miners like Northern Star Resources, which benefited from fear and uncertainty from President Trump's tariffs and erratic shifts in trade policy.
They're reflecting the price of gold, which has been on an absolute tear, at record highs. There's an extent to which investors are flying to safety.
Consumer stocks also generally pleased investors.
The trading updates are coming through a lot better than what the market's been expecting, such as Coles, A2 Milk, as well as companies like Metcash, for example.
And Qantas announced a full-year profit of $1.6 billion, its second highest ever, because of strong demand for travel and falling fuel prices. Despite a volatile earnings season, the Australian share market still climbed into record territory, surpassing 9,000 points.
Overall, history shows the longer the share market continues to trade at record highs without a significant improvement in earnings, the higher the chance of a reality check at some point. Usually that means big falls ahead. But of course, it's impossible to predict when that might happen.
We've had, since mid-2022, share price gains of about 40% across the ASX 200, but across that time, earnings have basically done nothing. In fact, for our largest companies, they've actually gone backwards.
Higher risk for little return.